Shares of MSCI are up 1% in today's session after Wells Fargo called it a, quote, best in class, shrugging off yesterday's short report by Spruce Point Capital, which sees a 55 to 65% downside risk in that company. In the report, Spruce Point calls MSCI a, quote, classic case of a struggling company failing to transform itself while engaging in value-destructive and, even worse, nepotism-like acquisitions and share repurchases. It also accuses the company of abusive financial reporting and accounting tactics to bolster earnings. In a statement to CNBC, MSCI responded by saying it categorically refutes the claims in the report published by Spruce Point Capital Management. This report, it says, is an intentional attempt by a short seller to target our stakeholders with misleading, incomplete, and false information that aims to distract from MSCI's successes and opportunities. And here now with us to respond to that statement from MSCI is Ben Axler, founder and chief investment officer of Spruce Point Capital Management. Ben, welcome. Good to see you. This is going to be a lively conversation, I'm sure. Let me begin with this. It says in my description about Ben Axler that you're an activist short seller, we agree, forensic financial researcher, certainly that, who has dedicated his career to exposing financial schemes. Is MSCI, with a blue-chip background and heritage, a financial scheme? And if so, why?
Well, I think the company clearly is trying to create shareholder value and increase its stock price. Now, where we think they've gone wrong is through expensive acquisitions that we think haven't lived up to the expectations. We think they're repurchasing their stock at an industry high 17 times revenue multiple. We think that money should be dedicated more to dividends. And, we think that, to the point about it being a mature, struggling company, that they're engaging in aggressive accounting and financial reporting to project an image of growth, where we think ultimately they're going to struggle to meet expectations as the industry transforms and their solutions become more commoditized.
These are operational, largely. That's my characterization, not yours. Operational issues: how the company is being run, what it has done in terms of acquisitions, how it is handling share repurchases versus dividends, and so these are legitimate criticisms, I'm sure, from where you sit. But is it a scheme?
Well, I think every company operates a scheme to improve their share price, right? But I think where we believe that management is being aggressive in terms of how they're portraying their growth, how they're portraying their margins, and how they're depicting their revenue. So, for example, in our report, we noted we've seen some aggressive revenue recognition policies on non-recurring revenue items. We also have issues about the cost allocations and whether or not the margins in certain segments are increasing. So that is
one of the bones you have picked with the company as we talk about revenue recognition and things like that is the fact that the chief accounting officer left about 6 months ago. Am I right on that?
Correct.
Has not been replaced. The job is now being functionally covered by the chief financial officer. You think this is bad?
Yeah. So we do have concerns about the governance.
And the comptroller has gone. Right? There is no comptroller.
Correct. So there's some governance improvements that we think could be made. Look, we credit the CEO, who's been with the business since 2007. He's created a lot of value. He's also the chairman. But, we think as the company's end markets and customers change, that the company needs some change at the highest level, at the CEO level. In addition, we believe the company should split the CFO and chief accounting officer roles. That's a concern. We also have a concern about the audit engagement partner, who is not explicitly a financial service or technology expert, is a chemical and industrial expert. So we think there's certain things they should do to improve the governance and the confidence in the company's financial reporting.